Hello and welcome to the program. I'm Ladi Williams. First off, let's take a look at how your money is performing at intraday. From markets we track in Africa, the lone downer was Nigeria's NGX, though marginal at 0.01%. It sustains the bearish sentiment, which has been recorded all through the week. South Africa's index, the JSE, was doing well, up about gaining half of a percentage point. Egypt's EGX closed for Friday, while the Nairobi Stock Exchange closed positive yesterday, up 0.93%. Now to the Middle East, where major equities were mixed. Intraday, the United Arab Emirates and the Abu Dhabi index up about 0.98%, same as Dubai. That was up 0.49%. Still within the region, Saudi Arabia and the Qatari exchanges are closed today, but closed positive on Thursday. Now let's head on to Europe, where the decision came and did not disappoint. The ECB hiked interest rates by 0.5% yesterday. Let's talk about the impact it will have on different European countries and the reaction of the euro and the markets. We have Rob Watts right there with the details. So, Rob, was the 0.5% hike a surprise?
Well, for many people across Europe, it was. There was an expectation that the ECB would increase interest rates by just 0.25 percentage points on Thursday. Indeed, that was what the ECB had said in its previous guidance. But in the run-up to the decision, there was this feeling developing that a bigger increase seemed likely. It was a major decision taken by the European Central Bank, which hasn't hiked rates for more than a decade and was under a great deal of pressure to do so, not just because inflation is running rampant in the Eurozone at a record 8.6%, well off the ECB's 2% target, but also because it was the only major central bank that hadn't increased rates this year so far. This now ends the prolonged era of negative interest rates for banks parking their cash at the ECB overnight, and will in time mean more expensive borrowing for Europeans. The ECB says more rates rises will be appropriate, as they put it, as it looks to catch up with the likes of the Federal Reserve, which has announced 3 hikes already this year. But analysts say the potential for the Eurozone to maybe tip over into recession later this year means the period of higher rates may not be a long one.
Yeah, the ECB playing catch-up, at this time. Well, the Eurozone consists of about 19 different countries. Will this impact some more than the others?
Yes, because those 19 countries all have different levels of debt, and it's the countries with the most debt that are most concerned about this rise in interest rates. That's primarily countries in southern Europe, and foremost among those is Italy. We saw a big sell-off of Italian bonds on Thursday after this rates decision came through. The timing could scarcely also have been worse in that respect, because the ECB's announcement came on the same day that the premiership of Mario Draghi in Italy fell apart, and he resigned, plunging the country into more uncertainty. To try and ease the stress of countries like Italy, the ECB announced what it's calling the Transmission Protection Instrument, which is basically a crisis-fighting tool. It involves the buying up of government bonds, and ECB President Christine Lagarde says the bank won't hesitate to deploy it should the Eurozone start to see a big imbalance in the borrowing costs between member countries. She avoided saying that the TPI, as it's been shortened to, was created with Italy in mind, but instead said it was designed to tackle problems that any member state could potentially face.
Right, and analysts see different countries actually responding differently at this point. But the ECB obviously oversees the euro. What impact did this have on the currency?
Well, it set the euro on course for its best week since May. That's quite the turnaround, given that only last week we were talking about it hitting parity with the US dollar for the first time in 2 decades. Immediately after the ECB's announcement, it did make a knee-jerk leap up against the dollar before settling at a more modest higher level. The reason for that bounce? Well, the ECB's decision brings its monetary policy much closer to being in line with the US Federal Reserve's, which oversees the American currency. The euro also received a boost from what we were talking about yesterday, the resumption of Russian gas flows through the Nord Stream 1 pipeline. But that news about the resignation of Mario Draghi as Italy's PM did also pour cold water on things. As for European markets, which had long been anticipating the ECB's decision, when it came, they don't appear to have really known what to make of it. There was no big stocks boost nor sell-off, except in Italy, where it compounded the pessimism brought on by the country's political troubles.
Right, all eyes are still on that gas supply, to Europe at this point. Thanks so much, Rob Blatt, right there in Berlin for those details. All right, now let's head on to the UK. We have Juliana there standing by. Great to have you, Juliana. So, UK's competition regulator has criticized 6 of Britain's biggest high street banks for breaking rules on giving correct information to customers. Tell us more about this.
Yeah, that's absolutely right, Laddie. Good afternoon. The Competition and Markets Authority have named and shamed 6 pretty well-known high street banks, which include the Bank of Ireland, Barclays, HSBC, Lloyds Banking Group, Metro Bank and NatWest. And this is all for them failing to comply with rules that were imposed in 2017 by the CMA to make sure that customers were kept up to date. And it kind of revolves around overdrafts and interest payments and issues concerning that. And now what we know is that a lot of these customers that were caught up in these failures, which include Barclays not updating customers on how much they would be charged if they fell into an unarranged overdraft. They've received this money, but it has set out a really clear warning to banks. Particularly, we know we are going through the year of the squeeze, as I know you've called it, Laddie, a huge cost of living crisis, and a lot of people struggling at the moment, and there's nothing worse than expecting to have a certain amount of money in your account, and you see that the bank has taken something for unexplained charges, which is what the CMA have been probing for over a year. So they have named and shamed these banks. We haven't had a detailed update from the banks who have received these slaps on the wrist, but many of them have said that they are going to comply in the future so that something like this will never happen again.
Quite interesting. Well, 2022, year of the squeeze. I wonder what 2023 is going to be called. This one we'll keep watching, though. But what's happening with Dover Port, with travelers facing a long ways to cross the channel?
Yeah, this is a huge issue in the UK at the moment, particularly because if you have children that study in England or Wales, it's the start of the summer holiday. Whoopee! We've got 6 weeks of trying to keep children happy, and that's what families have been trying to do, because according to the RAC, which is a motoring group, 18.8 million leisure trips are going to be taking place in Britain this weekend, and many of them are to go to mainland Europe. And because of all of the issues that we've been having in the airports, lots of people have decided to drive to Europe, going through Dover, but a national emergency was called this morning because queues are apparently up to 6 hours long. Now, the Port of Dover have blamed this squarely on French authorities. They have said that they knew about this surge in holidaymakers months before this date, but unfortunately they just don't have enough staff at the border. They don't have enough police to try and keep the crowds down, and so at certain points this morning the port did actually have to close. I am following this story right now, but it is still seen as a critical incident, and such a shame, of course. You can imagine, I know you've got children, Laddie, trying to keep them in the car sane for 6 hours minimum.
That's long.
Stuck in traffic is not great, although I know traffic is something that does affect
even the tablets and gadgets won't save you from that. Well, it is the last trading day for the week. How's it looking?
Looking pretty good. It's been up and down, hasn't it? We've had significant data showing that inflation is not abating anytime soon. We also had retail sales figures earlier this morning, actually, showing that retail sales are dipping, unsurprisingly, because people just can't afford it. You know, people would rather keep wearing that same outfit than buying another one, because wages are also stagnating. But, however, there have been some positive trading updates, which has lifted the all-share at intraday. It's up 0.46%. FTSE 100 up 2 by 0.37%, and the FTSE 250 up by 0.97%. In the currencies market, the British pound is currently trading down against the US dollar by 0.47%, though up on the euro by 0.16%, but down on the Japanese yen at intraday by 0.58%, Laddie.
All right, Juliana, I guess I'll be holding on to this suit that I'm wearing for now, not looking to change it with this squeeze.
Me too, me too.
All right, Juliana, thank you so much. Enjoy the weekend.
Thank you. You too. Thank you.
All right, now let's head on to other markets. We see shares in Asia Pacific were mixed today as investors digested Japan's inflation data. The Nikkei 225 recovered from earlier losses to rise about 0.4% and close at 27,914 points. The Topix index climbed 0.28% to 1,955 points. Official data released show that prices in Japan rose 2.2% in June compared to a year ago, in line with analysts' expectation. South Korea's Kospi was 0.66% lower, 2,393 points, and the Kosdaq fell 0.68% to 789.75 points. In Australia, the S&P ASX 200 was little change at 6,791 points. And oil prices fell slightly today after sliding around 3% in a previous session on weakened demand in the United States, the world's top oil consumer, and a pickup in supply from Libya. Brent crude futures dipped 81 cents to $103.02 a barrel, while U.S. WTI crude futures were down $1.12 at $95.23 a barrel. WTI has been pummeled over the past two sessions after data from the U.S. showed that U.S. gasoline demand had dropped nearly 8% from a year earlier in the midst of peak summer driving season, hit by record prices at the pump. And Nasdaq futures fell today as investors digested a fresh batch of corporate earnings that included disappointing results from Snap, which sent social media shares reeling. Futures tied to the Nasdaq 100 traded 0.5% lower, while the S&P 500 futures slipped 0.3%. Dow Jones Industrial Average futures dipped about 0.50%. All right, now to our next conversation. South Africa's Reserve Bank has tightened policy 5 times in a row, with the magnitude of rate hikes not seen in 2 decades. That hasn't done much to help the rand. Now, at this point, let's talk to Matt Kindigan now, practice leader, Sub-Saharan Africa Front of View. Great to have you, Matt.
Hi, Larry. Good to see you today.
Yeah, so it's another hike, and it's like hike season everywhere at this point. Did you expect it from South Africa?
Yes, is the short answer. So we were expecting the hike by the South African Reserve Bank, and this is because the Reserve Bank has said in the past that it is keen to raise interest rates to try to tame inflation, but also protect the value of the rand or prevent instability in the rand. And we are seeing this across other parts of the world and in sub-Saharan Africa. So we certainly were expecting this, although the very sort of large increase in rates was not quite expected. But what this does show us is that we are likely to see further interest rate hikes in South Africa going forwards. And this is as a result of regional and global factors, or national and global factors. So firstly, we are going to see a strengthening US dollar. We have seen tighter monetary policy in the US and the Eurozone. You know, the most recent increase in interest rates by the European Central Bank has shown that there will be pressure on capital flowing out of South Africa. And so we certainly do expect to see the South African Reserve Bank continue to raise interest rates. And there's also the issue of inflation. So as inflation remains well above the Reserve Bank's upper target limit of 6%, there will also be extra pressure on them to try and curtail the inflationary effects that the country is seeing.
And how do you see this impacting, the manufacturing sector in sub-Saharan Africa? Because everyone is tightening at this point.
Yeah. So from a manufacturing perspective, it certainly is not great, because many countries, including in South Africa, we've seen relatively cheap credit over the last 24 months or since the beginning of the pandemic. And this is because in an attempt to stimulate the economy, the South African Reserve Bank slashed rates to the lowest level on record. And as a result, businesses, households, including in the manufacturing industries, were able to borrow at much lower rates. And we did see what we were expecting to see this continue for a longer period of time. So we could see businesses begin to delay or withhold investments. We could see them postpone investments into equipment. And so this could be relatively bad for for the manufacturing industries.
Quite interesting. And how do you see higher interest rates, affecting the outlook for the rand? We've seen, rate hikes in Nigeria. The naira is not doing any better, and it looks like it's not, working for the rand also.
Yes. So what I would say is that we'd probably see even more aggressive depreciation or more substantial depreciation of the rand in the absence of tighter monetary policy taken by the South African Reserve Bank. Our view is that we are going to see continued depreciation of the rand through the rest of this year and into next year. And as a result, the South African Reserve Bank will be forced to intervene. So by raising rates. So we do expect to see there to be some benefit for the value of the rand or the stability. But what the South African Reserve Bank can't control for is things like the country's trade balance, which is going to be turning more negative. And this is because we expect export revenues to soften over the next year or so. Some of South Africa's key commodity exports, coal, iron ore, and gold, to an extent, are expected to continue to soften as the global economy slows, mainly led by a recession in the US and likely in Europe as well. But we're going to see persistently high oil prices, which will mean that the fuel import bill for the country will remain very high. So we're going to see weaker export revenues, very high-priced imports, and this will put pressure on the currency. So more depreciation, but South African Reserve Bank interventions will prevent even more severe depreciation, in our view.
Right. And do you expect the economy more broadly to be affected by these rate hikes?
Yeah. So as we talked about just now about manufacturing, credit growth is or has been one of the lifelines that the South African economy has seen over the last 2 years. So despite quite weak domestic economic fundamentals, very low interest rates have encouraged consumers to spend and invest and purchase products and services that they may not have committed to if interest rates were higher. We've also seen the government's debt servicing bill actually remain a lot lower than we were previously expecting as well. And so this has meant that the government has avoided some of the most severe spending cuts and tax increases that we were previously expecting. So what we are going to see is some of these drivers, so credit growth as a driver of investment and spending in the market, begin to taper off. And this is not great news for the South African economy, because the other drivers of growth, such as exports, tourism revenues, consumer spending, are already, are already quite weak in the market. So we would say it is a contributing factor to a slightly more pessimistic growth view for the economy. We're now forecasting growth of about 2.2% for 2022, and this is down from about 2.7%. And high interest rates have been a major contributing factor to this downgraded growth view for this year.
Yeah, and looking at, sub-Saharan Africa at this point, do you think, the economies here should be looking at hiking rates? Because there is that concern that the rate hikes are not taming inflation at this point.
Yeah, so there's this quite a large debate at the moment about whether interest rate hikes will curtail inflation, because arguably the inflationary spike that we're seeing at the moment is supply-driven, so largely a result of higher commodity prices, fuel prices, agriculture commodity prices. That all stems from the conflict in Ukraine. And there's very little that a reserve bank or a central bank can do to influence these factors. There is some argument that in markets where we are seeing quite strong economic growth and improving economic conditions, Angola is one. In Kenya, we were also seeing very upbeat economic performance. To an extent, interest rate hikes can soften demand growth, and this does discourage companies from raising prices. What it also does is it provides a bit of a cushion for the currencies in these markets, and this does mean that the price of imported products, again, is tamed a bit as a result of improving currency stability. So our view is that rising interest rates are probably not going to be as effective as they would if we weren't seeing this historic spike in commodity prices, but they will probably, to a certain extent, help to solve the problem.
Yeah, well, we'll be looking out to see how the sub-Saharan African inflation actually tapers at some point. Hopefully that happens with all the rate hikes we're seeing at this point. Thank you so much, Matt Kindiga, practice leader, Sub-Saharan Africa at Front of You. It was great having you.
Thanks, my pleasure.
All right, still in southern Africa, Zimbabwe's mining sector is registering unprecedented growth for the first time in history, with earnings jumping to $5.2 billion in 2021 from about $2.9 billion in 2017 as the positive gains continue. Officially opening the 25th edition of the Mining, Engineering and Transport Conference in Bulawayo, the Zimbabwe International Exhibition Center President Mnangagwa rallied industry players to ramp up production and embrace modern technologies to scale up capacity and business competencies in line with global best practice. Official statistics already indicate that the mining sector is poised to clock $8 billion in earnings this year, having already surpassed the $6 billion last month. Government has set an ambitious target for the mining sector to realize a $12 billion milestone by 2023. This, despite unforeseen shocks, remains certain, judging by the continued momentum across key subsectors and the newly commissioned signature projects covering different mineral segments. And Ghana's international reserves declined from $8.1 billion in May 2022 to $7.6 billion in June. This is based on a Bank of Ghana document which shows that the reserves cover 3.4 months of import cover. It's coming after a finance committee report proving $750 million loan between Ghana and the Afrexim Bank pulled the reserves at $3 billion from an initial position of $9 billion. And regional lender Equity on Thursday signed a memorandum of understanding with the East Africa community to help fast-track its Africa Resilience and Recovery Plan, largely targets small and medium enterprises. Both parties see the MOU as a vehicle for financial support and development financing, using the EAC infrastructure of a common market and targeting farmers, manufacturers, energy and social services providers, and to stimulate intra-continental trade. Equity CEO noted that the EAC is best integrated and connected economic bloc in Africa, even though it's been hit by disruptions by COVID-19 and other headwinds. And that's it on Business Incorporated. Thank you so much for watching this week. I'm Ladi Williams. Bye for now.